On February 5th, 2026, the United States government announced a policy that has only been implemented 3 times in the last century during national emergencies. Vice President J.D. Vance confirmed the establishment of a price floor system for critical minerals. Including silver, this is not a market suggestion. This is a government mandate. And if you understand what a price floor actually means, you already know what happens next. This is mathematical certainty. The cheap silver era just ended, and most people won't realize it until it's already too late. Let me show you the pattern. Because this has happened before, 3 times in recorded history, empires facing resource scarcity and currency collapse implemented price controls on strategic commodities. And every single time, it marked the final stage before total systemic failure. Not a warning sign, the final stage. Rome in 301 AD. The Edict of Diocletian set maximum prices on over 1,000 goods because their silver denarius had been debased from 95% silver content down to less than 5%. Think about that. The currency that built an empire, that conquered the known world, that facilitated trade across 3 continents, reduced to worthless base metal with a thin silver coating. They needed to control prices because their currency was collapsing in real time. Merchants were refusing denarii. Soldiers were demanding payment in actual silver, not coins. The government panicked and implemented comprehensive price controls. The edict failed within months. Black markets exploded. Goods disappeared from official markets entirely. The empire fragmented within decades. By 476 AD, Rome had fallen. Verified. The Dutch Republic in 1795. Facing invasion from revolutionary France and the collapse of their guilder, they implemented grain price floors to prevent starvation and maintain military supply chains. The guilder had lost 60% of its value in 3 years. The Amsterdam Exchange, once the financial center of the world, was in chaos. They were trying to keep strategic resources available at any cost because the currency couldn't command real goods anymore. The system collapsed anyway. The French invaded. The Dutch lost their global reserve currency status within 5 years. The British pound took over as the world's settlement currency. The Dutch Golden Age ended not with a war, but with a currency crisis. Check. Great Britain, 1946. After World War II devastated their economy and the pound sterling was hemorrhaging global reserve status, they implemented price controls and rationing on everything from steel to coal to food to clothing. This wasn't wartime necessity. The war was over. This was currency crisis management. The pound couldn't command resources from the empire anymore. India, Africa, Southeast Asia were all demanding payment in dollars or gold, not pounds. Britain was trying to guarantee supply of critical materials for reconstruction while their currency was dying. It didn't work. By 1949, they devalued the pound by 30% against the dollar in a single day. The empire dissolved over the next 2 decades. Britain went from controlling a quarter of the world's landmass to being a secondary power. All because the currency failed? Verified. Same pattern, same sequence, same outcome. Currency loses purchasing power. Government panics about strategic resource availability. Price controls get implemented. The controls fail because they're treating the symptom, not the disease. The disease is always the same. The currency itself is dying, and the empire dies with it. And now, February 2026, the United States announces a price floor system for critical minerals. Not price ceilings to fight inflation. Price floors to guarantee supply. Do you see it yet? You can't unsee it once you understand what you're looking at. This is the same play, same act, same final scene. We're just watching it happen in real time with smartphones and social media instead of town criers and pamphlets. Here's what a price floor actually means, and this is critical. It's not a suggestion. It's not a guideline. A price floor is a government guarantee that a commodity will not trade below a certain price. If market prices fall below that floor, the government becomes the buyer of last resort at the floor price. They did this with the Strategic Petroleum Reserve for oil. When oil prices crashed, the government stepped in and bought millions of barrels at guaranteed prices to keep American energy producers alive. And now they're doing it for silver, copper, lithium, rare earth elements, cobalt, nickel. The minerals you need for defense systems, solar panels, electric vehicles, semiconductors, weapon systems, communications infrastructure, missile guidance systems, radar, satellites. Why would they do this? Because domestic mining operations have been shutting down for 2 decades. When silver was trading at $18, $20, $22 per ounce, American mines couldn't compete with cheaper foreign supply from Mexico, Peru, China, Russia. Mines in Nevada, Alaska, Idaho were closing. The U.S. was becoming dependent on foreign sources for a mineral classified as critical to national security. If war breaks out with China and suddenly Chinese silver exports stop, how do you build Tomahawk missiles? How do you manufacture fighter jets? How do you produce solar panels for military bases? You can't. So now, the government is guaranteeing miners a minimum price to keep domestic production alive, regardless of what happens to the paper market. But here's the part nobody is talking about, and this is where it gets terrifying. What if the price floor is set above the current market price? Price floors are set based on production costs, plus a margin to ensure profitability. If it costs $70 to mine an ounce of silver in the United States when you factor in labor, equipment, environmental regulations, permitting, refining, and you want to guarantee a 25% profit margin to incentivize production, your floor is around $88 to $90. Current paper price, as of today, $86. If the government sets the floor at $90 or $95 or $100 and the paper market is trading at $86, what happens? The paper price has to adjust upward to meet the floor. Not eventually, not over time, immediately, because arbitrage makes it impossible for paper to trade below physical when the government is guaranteeing to buy physical at the floor price. If the government says they'll buy all silver offered at $95 and paper contracts are trading at $86, I buy paper at $86, take delivery of physical and sell it to the government at $95, $9 risk-free profit per ounce. That arbitrage closes the gap instantly. The paper market is forced to reprice upward to match the floor. This is not speculation. This is not hopium. This is not some YouTube guru telling you silver is going to the moon. This is how price floor mechanisms work in economics textbooks. The government sets the minimum. The market cannot go below it. If it tries, the government steps in and absorbs all supply at the floor price until the market adjusts upward. This is a repricing event waiting to happen, and the government just announced it's coming. Now let me show you what's happening in the physical market while everyone is watching paper prices bounce around. In the first 4 days of February 2026, the COMEX reported 14.8 million ounces of silver delivery notices. That's 2,955 contracts, demanding immediate physical delivery. Here's the problem. At the end of January, total open interest in the February silver contract was only 1,231 contracts. Do the math. Deliveries demanded are 2.4 times the entire open interest. That's not possible under normal market conditions. That means new buyers are entering the market, purchasing contracts, and immediately standing for delivery. They're not speculating. They're not trading for profit. They're taking metal out of the vault and leaving. And as soon as they leave, new buyers enter and do the same thing. The open interest stays low because nobody's holding contracts. Everyone's taking delivery. February is not a primary delivery month. March, May, July, September, December, those are the big delivery months when futures contracts typically see high physical settlement. February is supposed to be quiet. It's a roll month. Traders close positions, move to the next contract, very little physical changes hands. Last February, total deliveries for the entire month were under 3 million ounces. This February hit 14.8 million in 4 days. That's 5 times normal pace. And this is the second consecutive non-primary month to see historically massive delivery demand. January did the same thing. December before that saw unusual activity. Physical buyers are not waiting for primary months anymore. They're demanding metal now, in every month, regardless of contract structure. What does that tell you? It tells you someone knows something. It tells you institutions, sovereign wealth funds, central banks, or major industrial users are not trading silver for profit. They're accumulating physical silver because they've done the math on what's coming next, and they're getting positioned before the crowd figures it out. And here's where the pattern becomes undeniable. For 2 consecutive days, silver has rallied during Asian and European trading hours, approached $90 per ounce, and then gotten absolutely demolished during New York trading hours. On February 3rd, silver hit $90 and reversed $7 in under 3 hours during the New York session. On February 4th, silver hit $90 again and dropped to $83, a full 8% collapse in the same New York session window. That's not a market. That's a controlled demolition. Gold did the same thing. $220 per ounce drop in under 3 hours during New York trading. These aren't natural price movements. Natural corrections take hours, days, weeks. This is systematic liquidation during a specific time window when paper derivatives markets are most active and liquid. Up all night on physical demand from Asia. Down all day on paper, selling from New York. Same pattern, same sequence. Every single day for a week straight now. Let me show you what that pattern looks like in practice. During Asian trading hours, Shanghai opens. Chinese buyers, Indian buyers, Middle Eastern buyers are purchasing physical silver. Shanghai silver premium over Western spot prices has widened to $16 per ounce. That's a 19% premium. Chinese buyers are paying 19% more than Americans to get physical silver right now. 2 weeks ago, that spread was 12%. Last month, it was 8%. The premium is expanding, which means physical shortage is intensifying in the world's largest silver consumption market. European session opens. London, Zurich, Frankfurt. Physical markets are active. Premiums on physical coins and bars remain elevated. Dealers across Europe are reporting 4 to 6 week delivery delays on standard bullion products. The price continues climbing through European hours. Then New York opens. Within 30 minutes, massive sell orders hit the futures market. Not gradual selling, not distributed selling, concentrated algorithmic, high-frequency selling designed to trigger stop losses and cascade the price downward. It's not retail investors panic selling. Retail doesn't move markets by $7 in 3 hours. This is institutional, coordinated, and deliberate. Why? Because the paper market is not a price discovery mechanism anymore. It's a price suppression mechanism. As long as you can keep paper prices under control, physical prices stay somewhat anchored. The moment paper loses credibility, physical disconnects entirely and premiums explode. We've already seen this in 2020 when COVID hit and mints shut down. Silver spot was $15, but you couldn't buy a physical ounce for less than $25. $10 premium. The paper market said $15. The physical market said, we don't care what paper says. This is what silver actually costs in reality. Now connect the dots. Physical delivery demand is 2.4 times open interest. Shanghai silver is trading at a 19% premium to Western spot. The one-year silver swap rate minus U.S. interest rates just hit levels higher than the 2008 financial crisis and higher than the 2011 silver mania. This is a technical indicator that measures structural imbalances in the silver lending market. When it spikes, it means there's a shortage of physical silver available for lease, and institutions are scrambling to secure supply. It spiked in 2008 when Bear Stearns and Lehman Brothers collapsed and the financial system nearly imploded. It spiked in 2011 when silver went from $18 to $49 in 6 months as investors lost faith in central banks after quantitative easing was announced. And it just spiked again in February 2026, higher than both previous crises. Not opinion. Pattern recognition. The data is screaming that there's a structural shortage developing beneath the surface. The paper market is saying $86. The physical market is saying there's not enough supply at any price. The government is saying we're implementing a price floor because we cannot rely on markets to guarantee strategic supply anymore. Which signal do you trust? The paper price that gets smashed down every day during New York trading, or the physical market where premiums are exploding, delivery delays are extending, and governments are implementing emergency policies? Let me tell you what risk-off actually looks like right now, because this is where it gets worse. On February 4th, 2026, U.S. stock markets erased over $1.6 trillion in value in a single session. S&P 500 down nearly 1%, wiping out $580 billion in market cap. NASDAQ down 2.4%, erasing over $1 trillion. Russell 2000 down 2%, losing $64 billion. This is not a healthy correction. This is not profit-taking. This is capital fleeing equities. Scheduled nuclear negotiations between the United States and Iran, which were supposed to de-escalate tensions in the Persian Gulf, were abruptly canceled with no explanation. Oil prices spiked from $70 to $75 per barrel on the news. Geopolitical risk is escalating, not de-escalating. The Middle East is one miscalculation away from a regional war that could close the Strait of Hormuz and take 20% of global oil supply offline overnight. China's 4 largest gold-backed ETFs saw $1.3 billion in outflows over 2 days, the largest withdrawal on record. That's Chinese retail investors liquidating gold positions, likely because of margin calls or forced deleveraging. But here's what's interesting. While Chinese ETFs saw outflows, Chinese central bank gold purchases continued. The People's Bank of China added another 10 tons of gold to reserves in January. Retail is selling. The government is buying. That divergence tells you who understands what's happening. Bitcoin dropped below $93,000 after months of holding above $95,000. Ethereum fell below $12,100 for the first time since May 2025. MicroStrategy's Bitcoin position is now down over $2 billion. The crypto narrative of digital gold and inflation hedge is being tested in real time, and it's failing. When actual risk hits the system, crypto sells off with tech stocks, not with gold. Every single risk asset is selling off simultaneously. Stocks, crypto, bonds, real estate investment trusts, everything. Except gold and silver aren't collapsing. They're consolidating. Gold is holding above $2,150. Silver is holding above $83 despite the paper sell downs. They're acting like insurance, not speculation. And when the house starts burning, people remember why they bought insurance in the first place. Here's what nobody is saying out loud, but everyone who studies monetary history knows. We are not at the beginning of a crisis. We are at the end of a cycle. The 2008 financial crisis wasn't the crash. It was the warning. The Federal Reserve responded by dropping interest rates to zero and printing $4 trillion. That didn't fix the problem. It delayed it and made it bigger. The 2020 COVID crisis triggered another round of money printing, $5 trillion in 18 months. More money created in a year and a half than in the previous century combined. That wasn't a solution. That was the accelerator. And now, the 2026 price floor announcement isn't a safety measure to protect markets. It's an admission that the government has lost control of the pricing mechanism for strategic resources. The U.S. national debt is $36 trillion and climbing by $1 trillion every 100 days. Every single day, the U.S. government adds $10 billion to the debt. Every hour, $416 million. Every minute, $7 million. That debt will never be repaid. It can't be. There's not enough economic growth in the entire world to generate the tax revenue required to pay down $36 trillion in debt. So it will be inflated away. The debt stays the same in nominal terms, but the currency loses value, so the real burden shrinks. Interest payments on that debt are now over $1.1 trillion per year. That's more than the defense budget, more than Medicare. It's the second largest line item in the federal budget after Social Security. And it's rising. Every time the Fed raises rates by 1%, annual interest expense goes up by $360 billion. The government is trapped. They can't raise rates without exploding the deficit. They can't cut rates without reigniting inflation. They can't stop spending without collapsing the economy. There is no policy path that solves this. We are beyond the point of solving. The Federal Reserve's balance sheet expanded from $4 trillion in 2019 to over $9 trillion in 2022. They printed more money in 2 years than in the previous century combined. You cannot print 40% more currency without destroying 40% of its purchasing power. That's not economics, that's arithmetic. The money supply went up 40%, so each dollar is worth 40% less in real terms. It doesn't happen overnight. It happens gradually through inflation. But it's already baked in. The inflation's already in the system. It's just working its way through prices over time. And now, as the currency loses purchasing power, as inflation embeds itself into every sector of the economy, as foreign buyers start refusing dollars for commodities and demanding yuan or gold or other alternatives, the government is implementing price floors on strategic resources. Why? Because they know what's coming. They know the dollar cannot command real resources much longer. The world is losing faith in the dollar as a store of value. Not today, not this month, but the trend is undeniable. So the U.S. government is locking in domestic supply now before the market figures it out, before prices spiral completely out of control. This isn't a conspiracy theory, it's public policy. It was announced at a global critical minerals summit, confirmed by major media, and adopted as official strategy. The United States is setting price floors because market prices can no longer guarantee supply, and that should alarm you. The world's largest economy has just admitted that free markets no longer work for survival planning. When the system finally breaks, it doesn't happen with sirens and warnings. It happens quietly. One morning, your bank limits withdrawals, ATMs stop working, branches are packed. You're told there's a $300 daily cap with no timeline to fix it. At the store, prices have doubled. Eggs are $12, milk is $9, meat is rationed. Not because trucks stopped running, but because the currency is failing. Your paycheck hasn't changed. Your savings haven't changed, but their value has collapsed. Your portfolio is down. Bonds are crashing. Inflation is eating everything. Every dollar you saved is shrinking every day. The rules have changed. The game is over. You try to buy gold or silver, every dealer is sold out. Online retailers show 8 to 12 week delivery delays. Premiums are 50% over spot price. A silver eagle that used to cost $28 is now $130 if you can even find one. Gold eagles are $3,800 for a 1-ounce coin when spot price is $2,900. The paper price and the physical price have completely disconnected. The paper market says one thing. The physical market says we don't have any, and if we did, we wouldn't sell it to you at that price. That's not a collapse. That's a transfer. Wealth doesn't disappear during currency crises. It moves. It transfers from people holding currency and paper assets to people holding real things. Land, commodities, gold, silver. Productive businesses, hard assets, the things that cannot be printed, cannot be debased, cannot be inflated away. Here's the critical part. Most people only understand when it's too late. Wealth transfers don't happen overnight. For years, nothing seems wrong. Inflation creeps up, debt grows, strange policies appear, but stocks rise, housing climbs, and everyone feels richer. Meanwhile, smart money quietly moves out of paper and into real assets. Billionaires buy land, central banks buy gold, institutions secure physical reserves. They're not guessing. They've seen this pattern before. Then it breaks, suddenly. Paper disconnects from reality. Premiums explode. Shortages appear. Deliveries stall. By the time the public notices, the assets are gone. Gold is gone. Silver is gone. Productive land is owned. What's left is paper that used to mean something. We're past the edge now. We just haven't looked down yet. Gravity hasn't hit, but it will. Silver at $86 isn't expensive. It's the last moment of the cheap era. When price floors hit and physical supply tightens, access disappears, premiums soar, dealers run dry, delivery takes months, the window closes. History repeats this every time. Empires ignore warnings, mock preparation, then panic too late. Every system believes it's different. None are. The math never changes. This isn't advice, it's pattern recognition. Cheap silver isn't ending. It has ended. Subscribe if you want to see how this plays out in real time, backed by data, not hype. This channel doesn't tell you silver is going to the moon or going to zero. We follow the pattern, we track the numbers, we look at what governments are actually doing versus what they're saying, and we tell you what's real. No clickbait, no hopium, no doom porn, just pattern recognition and historical context. If that matters to you, hit subscribe, drop a comment. Let me know you're paying attention. Because the people who see this early, the people who understand the pattern before the crowd, are the ones who survive what comes next. Everyone else is just another statistic in the largest wealth transfer in human history.